Welcome. A plugged-in microphone is always a positive. Let's just make sure that I am on the right microphone and not the webcam. And then we are good. I'm seeing green bars. I'm seeing chats. Thank you, Talon. Great posting today. Very impressive. Thank you. Please keep them coming. And that really sets the stage for a vibrant community. So I really appreciate that. Please keep the posts coming. So we'll talk about the community in a little bit. We are doing this on a private live stream. For those watching this on the replay, there's a link below if you want to watch this live. Please do so. It's free. Take advantage of it. We have a great community, good people, and it's free for now, but it will not be free forever. We're going to need to charge at some point in time as we get bigger, as all the bugs get ironed out. Then we will certainly have a greater amount of engagement. And I'm sorry, I got my eye on this chart. I can't take it all. I'm trying to complete a sentence. I can't do it. I'm a junkie. I'm cracked up on coffee. I love equities. I love the stock market. We had a really good day today, and life is good. We have our health. Let's enjoy it. Let's get to it. Vago, I'm sorry. I have a thing, okay? I'm going to talk about Altria in a moment. It used to be called Philip Morris. Same symbol, different brand name. Broadcom, old symbol AVGO, Avago, which was merged with Broadcom. I can't stop calling it Avago. Would they please take sympathy on me? I am not that intelligent. I need support. You know what? In the members area, what we're going to do is create a support group for people who have learning disabilities like I do. So please join that, what we call space. I need, bear with me. My voice is going already. It's not what you think. Helps the throat. Okay, let's get to it. So Broadcom comes out after the bell today, and they reported. I'll be honest with you, I forgot all about it. Now, I haven't looked at the numbers yet. Broadcom Q3 adjusted EPS. They beat on earnings per share, sales beat. So we're talking about forward-looking guidance here. That must be the problem. I'm looking for, they declared a dividend of 50. I don't know if they paid a dividend and they're declaring a higher dividend. But usually when a lot of these companies report dividends or stock splits or an increase in dividend or share buyback, usually that means the forward-looking guidance is a little bit wonky. So they're trying to take your eye off of the guidance and keep it on the bells and whistles, the smoke and mirrors. So I'm looking for forward-looking guidance here. I'm not seeing it unless they missed on a whisper number. Oh, wait a minute. Here we go. Rare that the guidance comes out before. Broadcom sees EBITDA guidance of about 64%. Wow. On projected revenue. I mean, these are the names that, if they're going to throw these names out on good earnings, these are the ones that you want to put on your watch list, because we are short of the market. We added to shorts yesterday, and we plan on adding more in the next couple of days, unless, of course, what we're seeing here, this setup for a broader sell-off, is negated by a breakout, and we break out to new all-time highs. then we have to admit wrong, and we move to the sidelines to raise capital. So that's Avago. Again, Avago. Broadcom. Let's take a look at the reaction of the NASDAQ, and it's down 0.18%, not horrifically, but I think that were it not for tomorrow's non-farm payrolls, which we'll talk about more in a little bit, then we'd probably be down lower than where we're at. But I think that right now, in advance of these big data point economic reports, they don't want to sell the market off, but they don't want to buy it either. All right, so you're seeing a lot of wishy-washiness on the part of the street, and this may continue. If we get a number tomorrow that's as expected, maybe we get a relief rally. If it's as expected and we don't get that rally, we'll probably be lethargic through next Wednesday until we get the Fed's report of whether it's not going to be whether or not they cut rates, it's how much do they cut rates. So that's the big question. Now, taking a look at bear with me 1 second. Okay, so taking a look at the E-minis to see how they're responding, probably no worse than NQ. NQ is like the NASDAQ 100 triple Qs for the futures market, and it's just fractionally, so no great shock there. Volatility, let's take a quick peek at that. Volatility, I mean, this is a pretty bullish chart. Look at the Bollinger Band squeeze setting up on a 1-hour chart, and really nice consolidation here on volatility. And you know, if we follow through to the upside, I mean, a volatility squeeze like this, or also known as a Bollinger Band squeeze, with the Bollinger Bands trading in and around the Keltner channels, this is going to be a vicious move in whatever direction it takes. You know, if we come out with an earnings report, not an earnings report, a jobs report tomorrow that is welcomed by the street, and I'll be honest with you, I don't know what's going to be welcomed by the street. Is it going to be a worse number, meaning bad news is good news, or is it going to be a better number where good news is good news? I'm torn, to be honest with you. I don't know which way they're going to go. I think the street wants a 50 basis point cut. A miss on jobs will point the Fed in that direction and certainly be reflected in the Fed Watch tool, which we're going to go over in a moment. Now, the other way it could be viewed is this way, is that the jobs numbers come out worse than expected, and the Federal Reserve only cuts by a 1/4 basis point. That would be horrific. That would not be welcomed by the street. What may also not be welcomed by the street is if we get a good jobs number, not horrible, a good one, and they only cut by a 1/4 basis point, with economic activity appearing to be slowing down. So, you know, it's anyone's guess right now which way this market's going to go on news, and you could tell it in the market activity. It's very wishy-washy. It's a two-sided market, but by and large, a flat market. So that's my long-winded way of saying flip a coin. That's the way this market's going to go in the next couple of trading days. Now, longer term, there are events that are unfolding that are more predictable. And as technicians, what we want to do is we want to use multi-time frame analysis. We don't want to look at a daily chart first. We want to look at the weekly chart, the monthly chart, to identify what are the higher level time frames telling us about the probability of a trade short term. Are we breaking down on a weekly chart? Well, if we're breaking down already on a weekly chart, a continuation breakdown on a daily chart is probably going to have a higher likelihood of following through to the downside. So we want to get bigger in that trade. We're not there yet. We're short. We had a good day, but we're not willing to commit more capital just yet, because we know that just when everybody is getting more bearish on the market, rip your face off rallies tend to occur. You're humbled very, very quickly. And yesterday, I was scrolling through Twitter, and all of a sudden, everybody's aware of the uninversion of the yield curve, as if it had been a topic of everybody's live stream week over week, month over month for years. So when I see that, the contrarian in me steps up and says, you know what? Beware. Don't get overweight to the short side, because everybody appears to be getting bearish because of the uninversion of the yield curve. So let's let that chatter die down. In fact, the yield curve inverted again today. So we are back into inversion territory. We'll go over that chart in a moment. So that's the futures action. We're going to go over the weekly charts to see how we are poised to close out the trading week and what next week may be setting up like. We have the public forum, which is live. I'm probably going to be changing that name, creating a separate entity. That was what I was advised to do. So I've been in a lot of meetings about this, and I'm probably going to be doing that with people a lot brighter than me providing the feedback. So it's going to be at some point in time a paid service. It's not yet, because I have way too many bugs still in the system that need to get worked out, and we're trying to grow a community. So if you're not in this forum, it will be growing. It's growing mightily already. So there's a link below. Join now. And a lot of these live streams that you're watching are first aired in the community and then put out on replay. And you can see here that I put out the poll. What are your stock chart requests for tonight's live stream? And we have a couple of requests. I know that Talon has Altria, which we're going to go over as well. And I'm going to talk to you about, on that trade, the value of knowing how to trade ascending wedge formations. So let's get to it. Let's talk about the Federal Reserve's balance sheet. This was released today, and it is as of the end of business yesterday. And the Federal Reserve's balance sheet continues to roll off, but fractionally. So not much debt rolling off the Fed's balance sheet nowadays. So it looks as though they're getting ready to pump this back up. Economic data. S&P final U.S. manufacturing PMI. Before we get into this, let me say hello to folks. Sean, welcome, brother. Denny, welcome. Down a wee nip of the pure helps my throat. It's actually CBD oil. It's CBD oil. I'm so jacked up right now on coffee. It's just been such a hectic day. I've been drinking coffee hand over fist, and it's going to be a long night. So I got a lot to do. Happy Thursday, RB. Happy Thursday to you, my friend. Tomorrow will be a bloodbath for SP. Could be a bloodbath for SPY. We might see low 540s. Could be. It's a coin flip right now. Jody, welcome. Larry, Brazilian soy reduction, not great this time. China will have to come here to buy beans, so we favor beans over corn, wheat for now. Agree. Seasonality favors agriculture for the next couple of months. Bye, peoples. Good evening, everyone. Blessings. Blessings to you, my friend. We are not offended by those that share blessings. We welcome them. And the same back to you. Okay. Economic data. We are still in contraction on the S&P final manufacturing PMI. Construction spending came in a lot worse than what was expected. So construction spending is firmly now in contraction. The ripple effects across the economy are going to be felt. ISM manufacturing index still in contraction. Oh, so this was the revision for the prior month. All right, this is for August. Okay, thought I was seeing things. Wednesday, trade deficit. Nobody cares about that anymore. Job openings. So this is a major concern. Think about it. They were expecting 8.1 million job openings. So those are jobs available for you to go out and apply for. Actual came in at 7.7 million. Factory orders came in as expected. I don't know what the Fed's beige book came in at. Let's see what the headline says. 2/3 of Fed districts report flat or declining activity. That they'll admit. Beige book survey says layoffs are still rare, but firms are cutting worker hours. The prelude to jobless claims. You know when you're coming out of a recession, when not when you get new workers. What we look for when we're coming out of recession, I think it's on Market Watch. And I haven't talked about it in a long time. No, they don't have it here on Market Watch. It's average hours worked. And you'll see that it's no longer on here. They changed this. You had U.S. hourly wages. Oh, here it is. Here. Hourly wage. Oh, that's hourly wages still. But it had average hours worked. And once you see that begin to tick up, you may not see the unemployment rate drop. But once companies start to begin offering overtime, that's the prelude to expansion in the jobs market, because employers, they're not sure whether or not the vibrancy or the recovery in the economy is going to stick. So what do? They do the logical thing. They offer overtime to employees rather than hire new ones. So we'll keep an eye on that sometime down the road when I wish they still had that, when we start to come out of a recession, or when we are in recession. Today's ADP employment report missed by a mile. But many times the ADP report does not line up with the non-farm payrolls. Why? Because the government rigs them. They even admitted it. By nearly 1 million jobs over the past year. Initial jobless claims came in slightly hotter than what was expected. So this is kind of a good conversation to have about what the market may do tomorrow if we get a bad read on jobs. Because you take a look at the ADP employment numbers and initial jobless claims, those came in negative, yet the markets didn't rally on negativity. And in fact, when you take a look at the probability of a 50 basis point cut, it rose to back up to around 60% only. So I have little doubt that this has influenced the market's reaction today. Why this is increasing or has increased, I'm not quite sure. TrendSpider reached out to me about the how-tos of TrendSpider and platform learning curve. Really? That's good to hear. Yeah, I was the owner of TrendSpider. I alluded to somebody that was providing me some guidance on the new forum. We were chatting about it yesterday, and like literally the first thing. And he's a very, very bright guy, really bright guy. The first thing that jumped out at him was just like, you need to brand it. You need to brand it better. So I listened to what he has to say about business, because Not only did he begin TrendSpider, but he began a company called, what the heck was it called again? I forget the name, but he started up with a couple of partners, blew it out for big money. So he's a really bright guy, and so I listen to him when it comes down to the business aspect of what I do. So moving on, I don't want to get caught up on that. So this is a problem for the equity markets. They want a 50 basis point cut. So it doesn't appear at current that we're going to get it. That could all change tomorrow. Now, looking out next week, what could influence that? Next week, Monday, not much happening. Tuesday, or is this last week? What's Thursday? The 5th. This is next week. Doesn't the Fed meet next week? Oh, no, it's the following week. My bad. I thought they were meeting next week. It's the following week. Now, when are they meeting? When the hell is the Fed's meeting? I thought it was the 18th. It is the 18th. Oh, that's last week's. I'm looking at August. No wonder why. Dumbass. They don't have it published yet. They don't have it published, the economic data that's coming out between now and, oh no, we do get CPI. CPI comes out. And PPI. So that could influence what the Federal Reserve does, but I think only for the negative, because if it comes out hot, that means that this number is going to only get bigger, meaning less probability of a 50 basis point cut. Let's talk about Schiller PE ratio. Stocks feel very expensive on a rear view mirror basis, on a forward-looking basis, and using the Buffett indicator, we remain strongly overvalued. So not much has changed since last Sunday, folks. Looking at the yield curve. All right, so the longest yield curve inversion in history has ended with the 10-year Treasury yield at 3.77%, now 1 basis point above the 2-year. This must have been posted yesterday because it's now uninverted. Excuse me, it's now inverted again. Historically, the flip back is a positive after a long inversion has occurred. Agreed. We've been talking about this forever. I just like watching other people talk about it now. The Fed's balance sheet is now at its lowest point since October of 2020, down 1.85 trillion since April 2022. They still need to drop off about another $3 trillion to get to pre-pandemic levels. So you know they're not going to get there anytime soon. So we kind of knew this. I'm not going to spend a lot of time reading through this. Government hiring is inflating the jobs numbers. Private sector job growth as a percentage of total payroll fell to 38% in July, the slowest growth since 2020. Historically, every time the private payroll growth share fell below 40%, the U.S. economy was in recession. And what's the yield curve telling us? Right, we're going into recession. What is ISM manufacturing telling us? We're going into recession or are in recession. Tom Lee, after telling everybody, this is just a few days ago. I happen to like Tom Lee because he's made some ballsy calls, so I'm not knocking him. So apparently his models changed really, really quick. After telling everyone the Russell was going up plus 40% from here, Telecom Tom calls for correction after a negative 3% IWM day. I'm not going to knock the guy who's made some good calls. Let's play this.
The yield curve in the United States uninverted in the month of August. That means the yield curve went from being below zero, which is called an inversion, and into positive
and this
territory.
Is true.
This
Hold
is a
on.
signal that occurred.
According to Fred, a lot of people are saying that the yield curve uninverted yesterday, which was September. It did not. It uninverted last Thursday, and then it inverted yet again. I'm going to start this from the beginning.
The yield curve in the United States uninverted in the month of August. That means the yield curve went from being below zero, which is called an inversion, and into positive territory. This is a signal that occurred in May of 2007, a few months before the start of the global financial crisis, and in November of 2000, a few months before the 2001 recession began. In fact, every single time that this signal was triggered throughout history, it was right before an economic downturn in the United States. Even right before the Great Depression in the 1930s, the yield curve uninverted in October of 1929, right at the onset of the Great Depression. The reason this works so well is because the yield curve essentially shows us how financial markets are currently pricing in the state of the labor market. You can see the unemployment rate highlighted right here follows the exact path of the yield curve at any given point in time. When the yield curve is inverted, like in these instances, it means the labor market is very hot, and that often coincides with the moment where the Federal Reserve is raising interest rates and tightening monetary policy to cool down the labor market. As the yield curve uninverts and steepens, it means the Federal Reserve is loosening monetary policy because the labor market is cooling down and the unemployment rate is typically rising. And you can see this time has absolutely not been any different. We have the yield curve that's steepening and coming out of an inversion right as the unemployment rate in the United States has really begun to move higher. So does that mean that we're in the process of entering a recession where the yield curve is likely to steepen and the unemployment rate is likely to rise? Because if that's the case, that would be very concerning for the stock market. The yield curve steepening throughout 2023 brought the stock market down for a 10% correction. The yield curve steepening that we had between June and August of 2024 also brought the S&P 500 down for a 10% correction. If the yield curve were to continue steepening, it would mean more recessionary fears and it would bring the S&P 500 down as that's happening. Now, eventually, we think that's the direction that we're going to be heading into. And the stock market correction that we saw throughout the month of July and August was just a little bit of a taste of what's actually going to happen when the recession materializes. But you can see what's been happening more recently is that the yield curve is actually cooled back down, and the stock market as a result has been able to recover. This is what you call a whipsaw signal, and it's definitely not the first time that we've witnessed this. If we rewind to 2006, you can see it inverted initially in February of 2006. Then the yield curve began to uninvert, and this actually coincided with a brief correction in the stock market. Now look at what happened right after that. The yield curve reinverted as the recession was postponed, and that allowed the S&P 500 to break out to new highs. Rewind to 1998, and we also saw the yield curve very briefly invert in July of 1998. That was followed by the yield curve steepening and uninverting, which also coincided with a panic in the stock market, where the S&P 500 dropped by 20% during that period. Then look at what happened. You see the yield curve reinverting as the recession was postponed, and that allowed the stock market to surge back to all-time highs. Again, let's rewind to 1989. The yield curve inverted in the first half of 1989 and then uninverted throughout the month of June and July of 1989. But yet again, you can see the recession only occurred in mid-1990. So this signal right here was actually a whipsaw signal and led to a full year where the stock market continued to trend higher. So basically, over the last 40 years, we've had 3 whipsaw signals associated with yield curve inversions. So is that what we're witnessing today, where this was only a brief whipsaw signal that would allow the stock market rally to continue higher like it did in these instances? Right now, that's exactly what seems to be happening. And this is what we warned our members about right as the yield curve was uninverting and you had everyone talk about a recession. The problem at that moment for us was that there was no clear catalyst that was pushing the economy into a recession. You see, every single recession that we've witnessed throughout U.S. financial history has been triggered by some kind of a catalyst. In 1990, it was the invasion of Kuwait that triggered an oil shock. In 2000, it was the tech bubble that burst, where millions of tech jobs were lost, dragging the economy into a recession. And in 2007, it was the housing bubble that was bursting that led to a collapse in consumer spending, in consumer confidence, which again led the economy into a recession. Now, don't get me wrong, the economy is ripe for a recession. We think it's only a matter of time before this chart starts to look something like this. This has actually been the longest yield curve inversion since 1929, where the yield curve was inverted for over 700 days. This is a chart that we've shown before, plotting the number of days where the yield curve was inverted against the size of the market drawdowns that you typically see in the recession that follows. When the yield curve is inverted for a shorter period of time, it leads to shallower stock market corrections because the recessions are not as severe. When the yield curve is inverted for a longer period of time, it suggests that monetary policy has probably been too tight for too long, which historically has caused some pretty severe market drawdowns like the 1974, the 2008, and 1929 crashes. Today we are around here, which in our opinion puts the market at risk of a massive drawdown when the recession actually materializes. Now, I'm not going to get into our exact investment strategy in this video, but the trades that we have on our website at gameoftrades.com.
Okay, so I wanted to play that for you because I think they do a really good job of articulating a more historical perspective of the yield curve. My chart only goes back to around 2000, and that's usually what we talk about. But this here goes back to 1929. So a lot more context about the importance of the yield curve. And he's 1,000% right. We've seen the yield curve invert and uninvert twice already in the past week. So when I say that it's right now, which way the market goes is a coin flip. It's just that. It's a coin flip. Now, if we get jobs data tomorrow, which is good, hot, that is probably good. It's definitely good for the yield curve, but it only locks in a quarter basis point cut. In fact, it may put into question additional cuts. So while we may get a rip your face off rally, that doesn't mean it's going to last. So it's not time just yet to go full steam potato and go shorting this market. I think that is a very, very bad thing to do because you could get whips. You just use the word whipsawed. You could get whipsawed out of your position. So wait, you want to see higher highs out of that inversion. So watching a chart of the yield curve is no different than watching the chart of a stock, right? You want to see higher highs and higher lows if you're bearish. You want to see lower highs and lower lows if you're bullish. So me, I'm short. I want this to go up. I want higher lows and higher highs. The trend is my friend right now. So this chart here is very favorable towards our trades. And it'll only be helped out if the jobs data comes out negative tomorrow. We went over this. I think we're good. Let's do some weekly charts. I want to take a minute and I want to talk about one of my favorite setups, and that is the ascending wedge formation and how we use contrarian trading styles to identify good risk-reward opportunities. So I want to take case in point, Altria. I happen to love Altria. We do dividend capture plays on it. We've owned it, collected the dividends. I sold it too soon over a month ago, sold it, and I regret it. But we are now short of Altria. So let's talk about the trade for a moment. Let's talk about the whys behind the trade. So the first thing that we want to do is we want to take a look at correlations. All right, so what is Altria correlated to? It's correlated to consumer discretionaries. They are very highly correlated. Oh, actually, I can't do that here. You can see that this. I shouldn't have done this. The ratio chart. Philip Moore, Altria is clearly outperforming. Let's do this. Let's get rid of this. And let's do this. Now let's bring it up. What we're doing right now is we're searching for our edge. What is our edge? And our edge is that we know that there's a pretty tight correlation between the XLY and Altria. That correlation has begun to fade over the past few weeks, because if you take a look at a monthly chart, you can see this is more of a smoothing mechanism. You know, the historical trend is about 75% correlated, but that is now coming off. Why? It's because Altria yields about 7%. And it's a great company. Whereas the consumer discretionary names, let's face it, the consumer's dead. So the best of breed names like Altria, they're going to continue to grind up higher. The problem is with Altria is that you have a chart that is leaning up and into its monthly third standard deviation Bollinger Band, very, very extended. And on a daily time frame, up until last night, we had 16 straight up days for Altria. It's a record. In recent times, it's a record. And it's also what we like to call, in technical parlance, unsustainable. So when we see an opportunity like this, we have to say to ourselves, what is our line in the sand? Again, what is our edge over other traders? So what we do is we do what any child would do. And that is we get our crayons out and we draw some lines. First, we take a look at the weekly chart. And here is what you call an ascending wedge formation. You know, down here, it's all bullish. It's all good stuff. When you're bouncing off the lower band of support, you're probably going to rally back up to that upper band of support. The problem is that you're running out of room. And once you begin to blow through the upper band of resistance and you close there, that's kind of like a blow off top in the stock, index, whatever you're trading. It doesn't matter if it's a commodity, it doesn't matter. And at some point in time, you're going to get a reversion to the mean. And that reversion to the mean is going to be the bare minimum, the lower band of the rising uptrend channel. And after you blow through this resistance level, and if you break down below that lower band, in all probability, you're going to break down further. So that's the weekly chart. So we're good. On a monthly chart, we know we're overbought relative to the third standard deviation Bollinger Band. If you don't know what that is, it doesn't matter. In short, you're not supposed to be there. The rate of change on the stock, or the average true range over a period of time, has just gone out of whack. It's just too sought after. It's an overcrowded trade, and it's ripe for a contrarian pullback. So what we did here, and I got to be honest with you, one of our members, Sean, really, I was thinking about the trade, and he asked me about it, and I was like, you know what? It looks good. So shout out to Sean, because yesterday we broke through the daily upper band of this, again, an ascending wedge formation on not just a daily chart, but also on a weekly chart. We blew through it like a hot knife through butter and closed there. We went short. And today you had an outside reversal bar. We still managed to hold the lower band of support. But what we did is we put on an options trade called a zebra. And that zebra is when you buy a 70 delta option, two of them, 2-to-1 ratio. So you're buying two options at 70 deltas. That means that the option moves 70 cents on the dollar for every move of the share price. And then you sell an at the money, which is about a 45 to a 50 delta option, which helps finance the trade. It reduces your risk, and it allows you to enjoy a far greater profitability range than if you put on a put debit spread. So that's what we did, and we're up on the trade at current. I'm expecting more weakness here. Doesn't mean we're not going to get a counter trend move tomorrow. I shouldn't say counter trend move. I mean a rally back and then a roll back over on Altria. So we're short of this. It did well, and I wanted to share that contrarian trading style. This is how you identify edge. So I'm not looking to book profits here anytime soon. Let's take a look at Bitcoin. Let's go weekly view. Not looking good. So a risk-off bet here on Bitcoin, CRB commodity index. This was trying to break out a couple of weeks ago. It has failed. So this would imply deflation. Now this favors the probability of the Federal Reserve cutting by 50 basis points. The last thing the Federal Reserve wants is a round of deflation. We already went over the yield curve. Yields, they broke out last week. The question I have to ask myself as a contrarian is this. Is this a breakout of last week's, excuse me, is this a retest of last week's breakout? I can't rule it out. We've seen it way too many times. One trading day can mean a lot when you go over these weekly charts. So while this looks very, very bearish to me, given the fact that the trend is down, we can't rule out a reversal off of this breakout point. But that would require very strong jobs data tomorrow. Now, taking a look at bond prices on the week, they're looking good. No new weekly higher high yet. That's important. No new weekly higher high. But when you take, I'm sorry, this is a tips. Tips. I knew this didn't look right. TLT. Yeah, okay, that makes sense. TLT weekly chart, new weekly higher high. And on a daily chart, we look really, really bullish on a continuation breakout and a new 52-week closing high. Now, back to the tips for a moment. With the CRB commodity index weak, it calls into question the whys behind tips continue up higher. I do think that they will break out higher if they cut by 50 basis points because it's inflationary. They're gonna open the doors to inflation unless the economy is just such a cluster F and they can cut by 1 percentage point and it doesn't matter. We're in so much trouble that they need to go aggressive. In my opinion, 2022 was the rolling recession of 2023. Was this a bouncing recession? 2024, maybe a total market recession. Agreed. U.S. dollar. Folks, remember what's happening here that's different from the last round of rate cuts. The entire globe was cutting rates while we were cutting rates. So the dollar was able to rally. That is kind of a problem now because the rest of the globe, including Japan, is now tightening. And we're going back to cutting rates. So what does that mean for the US dollar? It's probably going to break down hard. What does that mean for import prices? They go up because it's going to take more dollars to buy those imported goods, and we import a lot. So the rate cut regime that we're going down right now is probably going to be inflationary on imported goods, and that's going to impact the entire economy, not for the better. So do we think that we're going to get follow through to the downside on the dollar? I think it's quite possible because when you take a look at the euro, bullish key reversal bar, one trading day left to go, you don't know what tomorrow brings. Yen, bullish key reversal bar, new weekly higher high, and a breakout if we close above 64. Volatility, breaking out weekly time frame. Again, one trading day left to go. And we know that means quite a bit when you're talking about the VIX. What do we do on the day today? Let's see how we perform. Daily chart. Volatility was down on the day. Dow Transports. They break out, they fail. They break out, they fail. At current, on the week, we're down over 2.5%. Not all inspiring, not exciting for equities. And take a look at the price action today. Down nearly 2% on the day. Dow Jones Industrial Average weekly chart, we broke out 2 weeks ago. We are threatening a failure. We are threatening to break back down into this trading range. So if we close down below, if we close at the lows of the week or worse, the Dow Jones Industrial Average, that rally is probably kaput, because this is a breakout point failure, also known as a bull trap. S&P 500 weekly chart, lower highs on momentum indicators. We have new weekly lower lows. We were unable to take out all-time highs. Volume is very, very light on the week. Daily chart. Daily chart, Bob. You'll get it eventually. We're holding support. Volume is dropping off. Let's go. And it's not a great shock. I think people are just sitting on their hands right now. 30-minute view. Just consolidating. They don't know what to do. But we've gone from higher lows. Granted, this is only a 30-minute chart. Higher lows and higher highs to now topping action, lower highs to lower lows. Trip Qs down over 3%. This is our primary short vehicle right now. We are short the Qs. We drew this trend line a while ago, a couple of weeks ago. Lower highs on RSI, lower highs on stochastics. How's volume? Volume is very light. So again, we can't go getting all bearish right now. It doesn't look good. And this really doesn't look good. This is what you call Wile E. Coyote moment stuff. So what we're doing here, what I mean by that is, I remember Wile E. Coyote. He would go running off that cliff and not realize he fell off a cliff. And then all of a sudden, when he realizes, he drops like a rock. So I always use that analogy, because what we're doing here is that we broke down below critical support at 465. Our prior support level was 473.23. We sliced through that like a hot knife through butter. Now 465. What are we doing for the past couple of days? We're trading sideways. We're tapping 465. What are they doing? They're selling it. So at some point in time, if the street doesn't get the numbers that it wants, we're going to get a Wile E. Coyote moment. These people that are buying here thinking that, you know what, this is the dip, I'm going to buy it. All of a sudden, the floor drops out from underneath them. Don't let that be you. When do we know we're wrong about the short? Well, when we start breaking out and recapturing support levels. We close above 465. Maybe we want to lighten up on that short. We're not there yet. Small caps. Let's bring up the IWM. This is a leverage product. Weekly chart. Down over 3%. Technology, lower highs. And I think that the worst chart that I've been seeing so far tonight is the weekly chart of the SMH, the semis. The NASDAQ must have the semis to continue up higher. I repeat, the NASDAQ, especially the triple Qs, must have the semis to rally. And Broadcom's earnings were not welcome news to the street overnight tonight. So lower highs here on stochastics, on RSI. Let's go daily view. Wile E. Coyote moment. Let's illustrate it so people understand what I'm looking at. Right here. Right? So we broke support. People are going in, buy the dip, buy the dip. I'm never going to get these prices again. Okay. So what happens? They rallied up to what was the high of the day? 227, let's call it 228. They rallied up to 228, rejection. That's only going to happen for so long, before, again, the bottom falls out. Franklin, welcome. OPEC cut oil production. That should be bullish for oil. I thought they went from they were going to increase production. They paused on that. Now they're going to cut production. We'll do that. We're going to go to that chart in a moment. Thanks for that. Michael Matthews. Did you short the Qs with long puts or bear call spread? I did. All right. So I did. I'll answer your question with yes plus. So we did long puts. We exited that trade. And we did a call spread on the futures, the MNQ, and we closed out that trade for profit. Now we are still short using the SQQQ. So if I were to initiate a short trade tomorrow, I would rather go the route at current of using a bear call spread, because at least if I'm wrong, I have a high probability of still being right because of the time decay. So great question and really good question. LABU, biotechs, you can't have the biotechs breaking down along with the regional banks, KRE. And this is probably what Tom Lee saw. He knows the correlations. He's not dumb. You got to have the biotechs. You got to have the regional banks for the small caps to rally. Once they begin to roll over, forget about it. Staples, we kind of spoke about this one already, but this has been a safe haven play, but it's getting long in the tooth. And a lot of people they're hoarding money in the Staples area because they think it's a safe haven and it's going to be resilient from a recession. That's not going to be true. I went over this on Market Wrap last night, that I went back to the past few reinversions of, excuse me, not the reinversions, these uninverting of the yield curve. The consumer staples buckled as well. Why is that? It's because margin calls go out. People will sell anything, or their brokers will sell anything to provide liquidity. So it's going to be a liquidity punch, and nothing except for possibly the dollar, possibly gold, and definitely bonds are going to survive. So will they get hit less worse than the NASDAQ? Yes, of course, because they have a yield. And when you have the treasury yield declining, people are going to stick with their staples because they're providing a higher level of return. Anyone know if NVIDIA is under investigation or not? Getting yes from Bloomberg, but no from, yeah, they had DOJ filed an investigation against them. I'm still not sure what it's all about. I was very, very surprised that the DOJ did that in advance of an election, because you had SMCI didn't file a 10K. AI, right? Now you have NVIDIA under investigation by the DOJ. Apparently, they don't know what's holding up the stock market right now, AI. So they're doing this in advance of earnings. You have confidence and bullishness already declining. Now you're going to initiate investigations into the major names holding up the AI space. That's a problem. That's not smart. But then again, we're talking about the regime. Dane, I didn't do chart requests yet, pal. Did you post it in the forum? If it's there, I will go over it. Discretionary names. I'm so surprised they're up on the week. I think this could be because of Tesla. Tesla was up yesterday. I got to see what that did today. They were up today. I got to check out Tesla. Wow. Tesla was up nearly 5% today. What's that all about? On volume. It's a good looking 30-minute chart. Good looking chart. Emerging markets. Rolling over. Now this includes China. Let's X out China. And you have a weak dollar and emerging markets can't catch a bid. That means that they're trading with the equity markets. Energy stocks. I wouldn't touch these right now. Now, these are going to be one of the first names to rally back. So once the rate cuts start kicking in, oil will go up and you're going to want to be buying energy stocks. Not yet. Let's go to a daily view here. I want to see how they performed on the day. Oof, brutal. Brutal. Oil. Weekly chart. Wow. Down 6%. Brutal. And this is all an indicator of slowdown. I think we are going to rally. I think this is a perfect example to illustrate the value of, we went over earlier, the ascending wedge formation. There's also the descending wedge formation. Same concept. But here, you don't have that steep of a sell-off yet on a weekly time frame. So this is not a high conviction trade. This is a scalp, in, out. So let's go back to the daily chart here for a moment. And let's illustrate what I'm talking about. And you can see you had the same thing back here. So if they drive oil down to around 68 bucks a share, I'd be looking to put on a trade there. Quick trade scalp out on oil. Same concept. Unsustainable downtrend. They blow it through the lower band of the declining downtrend channel. It hits support, last seen back in December. Then you get a rip your face off, counter trend, short squeeze rally. Gasoline prices, weekly chart. Good for the consumer, good stuff. Down over 6.25%. Natural gas holding in there. What did this do today? We own this. Not looking good. But it's yielding over 11%. Gold. Weekly chart is now up on the week, setting up for a continuation breakout up higher. Daily view. Nice. Let's take a quick peek at the gold mining stocks. We'll go to the juniors first. We own both of these. Juniors down on the week, but they're off the lows of the week. Improving. Daily chart. Recaptured support today. Not ready to buy more yet. Palladium we own. We'll hold on to it. Nice consolidation here. I'm out of sequence. Nugget. Another gold mining play. We have yet to recapture weekly support. That matters. Daily chart. Up day, but we faded off the highs. Not ready to act and buy more yet. Silver down in the week, but reversing off the lows. Good stuff. Let's go to chart request and call it a night because my voice is going. I have so many windows open. I think it was here. Yeah. Let's bring up TrendSpider. Folks, TrendSpider, one of our premier partners, 35% discount code. Use that link below and get their automated. As a matter of fact, apparently using my link or using my joining the contrarian trader now. They got rid of their 7-day free trial offer. So joining the contrarian trader gets you the only free trial to TrendSpider now. I was talking to the owner yesterday, as mentioned earlier, of TrendSpider, and because you're giving your people a great deal. So if you want a free trial, sign up for the 14-day free trial of the contrarian trader and get TrendSpider silver and gold level membership. What else are we doing here? I want to bring up the other profile. Plain view. Okay, let's talk about, let's go to the members area. And for those watching this on the replay, to get your charts reviewed, all you need to do is enter them here. Dane, I don't see your request here, pal. I don't see your request. What's your request? I'll do it for you because you've been a long-term follower, viewer, participant, a gentleman, a welcome spectator. Let me know what that is, and I'll get it for you. AAL. American Airlines, weekly chart. I heard some good news today about the airlines. I hate the space. I just hate the space. Let's go to a monthly chart first. I'm going to overlay on a weekly chart, monthly resistance. So this is a stock that's in no man's land. We know from earnings reports from like Booking.com and other companies that long distance travel is not doing well. However, from what I understand, the bookings for the airlines are still holding in there. Franklin's replying to Jody. I want to share that with everybody. DOJ also did the same with a few other companies, and it was more political than substance. Bad timing, though. Yep. Tesla, I was asking if there had been a huge run up already or time for a pullback. We'll take a look at the chart. Okay, we'll see where the support and resistance levels are. TrendSpider is much better for that, for automation, because it just is. This is better than stockcharts.com. Okay, so I would do this. One of two things. If this, then that. Right? So what we're looking at here is to buy right here, right now, is that you're betting on a V-shaped recovery. I don't expect an airline to really do that. Although it did do it back here. To be fair, I can't not acknowledge that. So it had a V-shaped recovery here. So we have a rally here. What I would want to see is a pullback to the support level here. Again, we're on a weekly chart, but monthly support and dashed line. I want to know if we touch or bounce off of it. And I would scratch the itch. I would open up a position, not my entire intended allotment of shares, but I would nibble, put a stop loss right below there, and then I would add more aggressively as we began to move up higher, especially if we rally up and through this resistance level and close there. And we'll keep this active probably a little bit longer than the first one. And that's it. Where's my alert? Why is it not showing my alert? All right, a little bit of a glitch. But our alerts are set here. And that's what I would do. Daily chart. I mean, I wouldn't buy this based on a daily chart. Bearish reversal bar. This is going to pull back. I would avoid this right now. I would follow the weekly chart and monthly support and resistance levels to be safe. Airlines are just not a good business. Now, what could be, I'm going to use this. This is an intended pun. What could be fueling them up higher, is oil dropping. Their input costs are dropping. I'm sure they're not cutting prices. So that could be why we're getting a goose on the airline stocks. All right, so Tesla, I was asking if there has been a huge run up already or time for pullback. And where do I put the request? You put the request. There's a link below. If you didn't sign up for the community, our forum, it's free. Link below, sign up, and you just enter it right here on the primary feed. It's like Facebook. Enter it, and you're good to go. Tesla. Let's do a monthly chart. I'm warming up here. I don't like the EV market, but I like the chart. But I wouldn't buy the stock. We're looking at a monthly chart. It's early in the month, way too early to be looking at a monthly chart as a breakout. Technically, we are breaking out our current. We have no idea if we're going to close above this mark. Let's go to the weekly chart with only one trading day left to go. Great price action this week. We broke out the week of the 19th, pulled back, and this week we got follow through. If we close above 232.11, watch for a retest of that support level the following week. You can nibble. I wouldn't get aggressive in advance of the Fed announcement. I would watch the yield curve, but it looks as though the path of least resistance is clearly to the upside. Daily chart. I wouldn't be the least bit surprised to see it retest back down to here, 210 per share. I wouldn't be the least bit surprised. I like momentum. Great W formation here. We broke out. What are we doing? Higher lows. Momentum is building. That doesn't mean we can't pull back, but momentum is building. It's actually looking pretty good. All right, folks, that's it. Folks, if you watch this on the replay, don't forget, join our free forum. Great people in there, awesome people. It's growing. We have a lot of people signing up. So please sign up. And most importantly, engage. We want people to engage. Please, if you have a chart that you want other people to provide feedback on, or if you want to share a great trade, this is where you do it. So please do so. Yes, there are bugs that we're working through. And after we work through the bugs and after we have a good, vibrant group set up, there's going to be a fee for this. So please, it's free right now and take advantage of it. And that's it. Everybody have an awesome night. And I will talk to you tomorrow, members. You are welcome, Franklin. Thank you, sir. My pleasure. Jody, have a good night yourself. Talon, have a great night. Dane, everyone out there, have a great night. Be well.